What's up, guys? In this video, I'm going to show you a really cool strategy that can allow you to get paid to buy stocks at low prices. So I know this sounds pretty crazy how you can get paid to buy stocks at low prices, and this strategy is called the cash secured put. It's very popular among institutions and people with a lot of money, and it's a more advanced options trading strategy, but it is extremely lucrative. So in this video, I'm going to be explaining how they work, the pros and cons, some tips I have, and then more importantly, a couple examples at the end of the video to just show you step by step how this whole strategy works. So, cash secured puts. This is a more advanced options trading strategy. Now, I'm sure everyone has heard of, you could buy a put, you can buy a call. If you buy a call, obviously, you want the stock to go up. If you buy a put, you want the stock to go down. But you can also sell calls and you can also sell puts. In this video, we're going to be talking about selling puts, which is a cash secured put. So, here's how the strategy works. So a cash secured put is a way for you to get paid to buy stocks you like at a low price. And let's explain how they work. So you basically just short put options and you will get paid a premium for doing this. But because you do this, you might have to buy the stock at a certain price. So for example, let's say we go to NIO. This is actually a great example the past couple days. Let's say, NIO is trending very strongly to the upside, and I really like NIO to the long term, but I don't like its current price of $48. I want to get it around 40. What you can do is you can go to the options chain. Let's say you go to the February 19th options chain, and you can sell a 40 strike put. And by doing this, you're going to get paid $315. If NIO is below $40 by expiration, you have to buy 100 shares of NIO at $40 each. If it's above $40, you just keep your $315 and run. So it's really that simple. And if you like the underlying stock for the long term, this is a win-win strategy. And you're never going to catch the absolute bottom. So for example, NIO might go all the way down to $30 and you still have to buy at 40. But if you find a price range where you'd love to buy a stock and you sell a cash secured put at that level, it's totally a win-win as long as you like the stock for the long term. So let's go back to the document to explain a little more. So here's the pros of this strategy. Time is on your side. So every day that goes by, that option that you sold is going to lose more and more and more value, which in turn just puts money in your pocket. So for example, the option that we were talking about with NIO, it might be $315 today, but tomorrow it might be $300 and then $280 and then $250. And it loses more and more and more value, which really benefits you. And then you also get paid immediately. So when you sell that 40 strike put, $315 gets credited to your account cash immediately. And then, like I said, you can get great stocks at low prices. You're literally getting paid to have the option to buy NIO at $40 each. Everyone else is paying $48 right now. Now, I know that sounds great, but the downside is, look at NIO might go down to $35 and you have to buy at 40. That's the only risk. But if that happens, you could, let's say you sold the 40 strike put, right? And NIO goes down to 35. Yes, you're going to have to buy some NIO at $40 each. But if you like that price for the long term anyways, nobody's going to catch the bottom, not even Warren Buffett, who's worth 80 billion. No one catches the exact bottom. So find a price point you like the stock at for the long term and then consider selling cash secured puts. A con of this strategy is it does require a good amount of buying power. So for every one put you short, you might have to buy 100 shares of that stock. So for NIO, let's say you shorted the 40 strike put. You're going to have to buy you might have to buy 100 shares of NIO at $40 each, which requires about $4,000. So that's a downside, is that it does require money, but you need money to make money. And if the stock does crash, like I kind of highlighted, you have to buy, let's say for example, NIO crashes down to $30, you're going to have to buy some at 40, but no one's going to catch the top or the bottom. All right, and then if we go back to some of the tips on the document, only do this with stocks you like for the long term. Like, I know there's a lot of people out here saying, like, I only have $1,000. What's a good stock I can do cash secured puts on? And if you only have $1,000, cash secured puts might not be the way to go, because if you have to buy 100 shares of something, you can only trade cash secured puts on stocks that are $10 or less, which most of the time there aren't any good deals like that. Like I see a lot of people trying to do like cash secured puts on like penny stocks and like really like bad quality stocks, and there's really no point of buying a stock if it's just going to depreciate in value over time. So my strong recommendation is to only do this on stocks you like for the long term. Personally, I think the best way to go about this is like selling them on SPY or Apple or NIO, if you like NIO, or DraftKings, or just any sort of stock that actually has some good value behind it. And then if we go into the examples, we can see, I wrote up a couple different examples. So let's say we look at DraftKings, right? DraftKings is currently at $49. And let's say you look at DraftKings and you say, all right, you know what? I like DraftKings for the long term. I like how they're trending upwards. I think they have a great future ahead of them. But I don't like the current price. It's at $49 right now. I would rather get it for around 40, right? So you could go to DraftKings and you can sell the 40 strike put that expires. You could pick the expiration date. In this example, I did February 19th of 2021. The premium for that option is about $155. So if you sell that option, you're gonna get $155 cash for doing that. No matter what happens, you're going to keep the premium that you sold the underlying option for. So when you sell that option for $155, no matter what, you're keeping that premium. That $155 gets credited to your account. For doing this, if DraftKings is below your strike price, which is $40 on expiration day, you're going to have to buy 100 shares of DraftKings for $40 each. Okay? So if you're going to have to buy 100 shares of DraftKings at $40 each, you're going to need about $4,000 collateral, okay? Now, here's the thing. I know some people are going to be like, well, what if DraftKings crashes down to 25? That's just a risk you have to take. But if you like a stock for the long term and you have an exact price point in mind, for example, $40, like let's say you like DraftKings and you really just want DraftKings at $40 and you sell a 40 strike put, you're still getting it at a great price. Keep in mind, no one's going to be able to catch the exact top or bottom, but this strategy is a great way to, one, get like income over time by selling the premiums, but also two, it helps you pick up great companies at great prices. And then if we look in, okay, so then I wrote a couple different scenarios. So just to recap, we sold the 40 strike put for $155. DraftKings is currently at $49. So scenario one, let's say DraftKings is at $49. It's still above your strike price, all right? The put you sold for $155 is now worth $0. It's out of the money, it's expiration day, and that put is worthless, right? So you keep your $155 and that's it. You don't have to do anything else because the stock is above your strike price. You're good to go. So this is a good scenario. You just picked up $155 and it's great. The next scenario is, let's say DraftKings crashes down to $35 and it's expiration day. No matter what, you're still going to keep your $155 as the premium you got for writing that option. Now, since DraftKings is below your strike price, you're going to have to buy 100 shares of DraftKings at $40 each because it closed below your strike price. Now, as long as you like DraftKings at $40, yes, you have to pay a little bit more than everyone else, but no matter what, you still got a good deal on the stock. And like, let's say you like DraftKings, and let's say you want to put overall $10,000 into it. You could put $4,000 in at $40 each, and you can just buy shares at $35 each to bring your average down. So no matter what, you're still getting a great price on the stock, and you're still getting paid to even be in this trade. So the main key here is find a stock you like for the long term and find a price point you like for the long term. Like, for example, if you look at DraftKings and you say, all right, I really like DraftKings to the upside, but I only want to get it at $35. Don't sell a put for $45 and sell puts that you're comfortable at, like the price points that you're comfortable buying the stock at. That's the whole point of the strategy, is to get great stocks at great prices, and a bonus is you get paid for doing it. So this is the ideal scenario. Really, it's a total win-win. So scenario 3, let's say DraftKings is just above your strike price by expiration day. Remember, we sold the 40 strike put. All right, let's say it's just above that. DraftKings is currently at $40.50. The put you sold for $155 on expiration day is out of the money, so it's worth $0, okay? So you're going to keep your $155, and then you don't have to buy any shares of DraftKings because the stock is above the strike price, right? So you keep your $155, but DraftKings still fell overall, and it's all the way down to $40.50. So you can just buy shares of DraftKings on the open market for $40.50. This is a complete win-win. One, you keep all of your premium, and then two, you can just buy the stock on the open market for a low price. You can buy as much as you want. You don't have to buy 100 shares. You could buy 20 shares. You can buy 50 shares. You can buy 200 shares. You can do whatever you want, but it really just gives you it's just the ultimate scenario because you get paid and then you get to buy as many shares as you want and the stock's already at a low price. So cash secured puts are a great way to get paid to buy stocks at low prices. It's very popular among institutions. The only downside is that it does require a little bit of money, but overall, it's a great strategy. I highly, highly recommend only doing this on stocks you like for the long term. I see a lot of people trying to do cash secured puts on penny stocks and it never ends well. So only do it on stocks for the long term, and in my opinion, only sell the strike prices at the prices that you are comfortable with buying the stock at. Realize that no one's ever going to catch the top or the bottom, not even Warren Buffett. But overall, this strategy is very lucrative. If you decide to do this, make sure to do your own research, look into the strategy, look into how cash secured puts work, maybe call your broker on their exact like buying power requirements and all that stuff. But I hope you guys learned something from this video. If you did, please consider subscribing. I post brand new videos every single day. But with that being said, Happy New Year. And if you have any questions, let me know in the comments down below. But other than that, thanks for watching.